As you know, I love your Twitter. I think your takes are very good. Your analysis is very good. But it's interesting because we're going to really be talking about value in Bitcoin. And the last person we discussed value in Bitcoin with was Peter Dunworth. And he was like, what was he? 800 trillion a coin? Or
7 billion was his bearish case.
Yeah, 7 billion was his bearish case. And you come out to a different conclusion. So
yes.
I think we're going to work through that. It was funny because when we prepare for interviews, we're like, what should we talk about? We'll go through, some of their Twitter, we'll come up with some things. But you wrote this brilliant article, but you also put all the questions in there. So if you look here, we've just taken all your questions out of your article. But we will share the article in the show notes. People have it. But tell me why you worked on this article, and it's probably a little bit connected to your work and your company OnRamp.
Yeah. Probably worth a minute of background here. So before falling into Bitcoin, I was a management consultant. I worked at Bain & Company. And what you do there is you come in, businesses hire Bain to solve problems. And you bring an analytical toolkit to figuring out like what's the size of a market, if this company should enter a market or not, or any kind of question like that. So it's all about entering an ambiguous situation and trying to triangulate answers by gathering data and firming up through a sample set what is reality here and what makes sense, and coming up with sensible analysis to guide your decisions. So then coming into Bitcoin, I brought that same sort of background and tendencies. And for me, in management consulting, a major exercise is what's the full potential of X, And for me, that quickly became what's the full potential of Bitcoin? What is this thing? Okay, it's digital gold. It's a digital store of value. Where's the ceiling? What's the full potential valuation of this asset? And that's a straightforward exercise, but there's a lot of missing pieces along the way in terms of you have to plug in what's the total addressable market, and then you have to to plug that in, you have to figure out what is the total addressable market and what are the pieces that go into that. So I spent some time cobbling together the pieces necessary to come up with my full potential valuation for Bitcoin, by starting with figuring out what is how much value is out there. So what's the total global asset landscape? And my triangulating and pulling in various data sources came up with 900 trillion. There's $900 trillion of value out there in the world in various store of value buckets. And that includes gold, but it also includes perfect.
So explain this to anyone who's listening or watching YouTube.
Yeah. So there's a bunch of different buckets here. These are your different store of value categories. You've got real estate, you've got equities, you've got bonds. You also have these smaller categories like gold, art, collectibles. And of course you have money itself. So, how much money is there? There's $120 trillion of money out there. And then you've got this tiny little thimble of a bucket that's Bitcoin. It's now actually about 500 billion. But so 500 billion out of $900 trillion asset landscape, that's 1/2000th of the world's value is currently Bitcoin. And all of these different categories have evolved over time to be in equilibrium because of their respective properties. Real estate is hard to make more of, right? So we've stored a lot of value in real estate because it's a good store of value asset. These all shift over time. And Bitcoin in particular has this inherent mechanic of increasing scarcity built into it that throws off the scarcity balance that's in this picture over time. Because Bitcoin gets more scarce, it will, in theory, attract more value into it because in 6 months, it becomes as good of a store of value as gold, which is currently a $12 trillion bucket. Specifically because the current inflation rate actually becomes a better store of value than gold. The current inflation rate, the amount of gold mined every year is 1.5% to 2% every year for the last century. Bitcoin right now is 1.8% issuance per year. And in 6 months, when the halving happens, that drops in half to 0.9% issuance. And in that moment, it becomes a better store of value. It gets debased, it gets diluted at a lesser rate than gold.
But can you really only say it's measure its utility as a store of value only based on that one factor?
Great point. No, this is one element that I think is actually undervalued.
Okay.
And part of that perspective is informed by Saifedean and the Bitcoin Standard, where he really makes the case for why gold emerged as like the store of value in the physical world, up until 100 years ago, really, up until the advent of central banking in 1913. And since then, everything has gotten a little wonky, right?
Yeah.
But the gold emerged as the winner because it's harder to make more gold than it is any other commodity. It's easier to make everything else except gold. You have to mine it. It's very hard to find and mine. And so I think that is the driving tailwind behind Bitcoin's value appreciation over time, among its many other attractive properties. I think that's kind of like the heart of it. Anyway, we can skip forward to the other graph of chart. So then, from a exercise point of view, if you believe that, if you understand that Bitcoin is going to become more scarce, it has this increasing scarcity, it becomes a more attractive store of value in the digital age. It becomes, the Lindy effect of it being more proven out continues. People get comfortable with it. They stop believing that it's monopoly money. They start realizing that there's substance here. It starts to attract value from people who are holding value in these other buckets. So, like today, $300 trillion is sitting in bonds, which has lost a tremendous amount of value over the last 2 years because of the sovereign debt crisis that we're facing. Like the amount of debt in the world and the deficits that governments are running, particularly the US, necessitate that we are going to have to print more and more and more, and inflation is going to be a problem. We have to inflate away the value of those bonds, which means that they necessarily will be a negative real return asset class over the coming decades.